Welcome to The Explainer. Today, we're taking some pretty dense macroeconomic theory and distilling it into something you can actually use, a business cycle trading cheat sheet. If you've ever felt like the markets are just completely detached from reality, well, get ready because this is going to be a massive light bulb moment for you. So think about this. What if you could actually predict the seasons of the stock market? It's really tempting to look at market volatility and see it as just this random, totally unpredictable chaos. But it's actually not. It's a predictable cycle of seasons that a savvy trader can navigate if they know what to look for. Think about it. You wouldn't wear a winter parka to the beach in July, right? Well, you absolutely shouldn't be holding the wrong assets when the economic weather changes either. You're probably wondering what actually causes these seasons in the first place. Well, at a basic level, the business cycle pops up in response to three major forces colliding: uncertainty, expectational errors, and rigidities. Basically, these are the real-world frictions that stop our economy from instantly adapting to curveballs, like sudden policy shifts, new tech, or natural disasters. So instead of everything adjusting instantly and smoothly, we get this wave, a cyclical push and pull of expansions and contractions. And we can actually map these waves out on a timeline. Historically speaking, the expansionary phase, the good times, usually runs for an average of about 39 months. The contraction phase, which is the painful recession part, is usually a lot shorter, averaging around 17 months. Together, they string along a very distinct timeline: initial recovery, early expansion, late expansion, a slowdown, and finally, contraction.
All right, let's dive right into our very first season: spring, the initial recovery, and early expansion.
So think of this phase as the economy's springtime. We've just survived a brutal economic winter, the ice is finally melting, and we're seeing all this rebirth and recovery. To really grasp why this phase feels so incredibly good, we have to talk about the output gap. Basically, that's just the difference between what an economy is actually producing and what it could be producing at full capacity. In the spring, since we're just crawling out of a recession, that negative output gap is still huge. What does that mean for us? It means the economy has tons of room to grow rapidly without immediately sparking dangerous inflation. And in this economic story, we have a really clear dynamic playing out. The central bank is stepping in as the hero in these early stages. They're pumping out stimulus and monetary easing to basically thaw out the freezing economy. But lurking right there in the shadows is our antagonist, inflation. Eventually, if things run a little too hot, the central bank has to turn around and fight that antagonist by jacking up interest rates. But right now, in the spring, the hero is still actively coming to the rescue. Let's look at what the actual data looks like during this phase. Business confidence is sky high. Those stimulus policies from the recession, they're still active, still propping things up. Inflation is actually slowing down because of that massive output gap we just talked about. And crucially, short-term rates and government bond yields are sitting near the floor. Borrowing money is incredibly cheap right now, which heavily encourages both everyday consumers and big businesses to open their wallets. Okay, so here's the million-dollar question. How do you trade this? Your spring trading strategy is all about getting in early on risk assets. Stock prices are climbing as everyone spends that cheap money. You'll want to invest heavily in cyclical assets. We're talking those riskier small cap stocks that absolutely thrive when the broader economy rebounds. But, keep your head on a swivel. You have to mentally prepare for the central bank to eventually start peeling back that massive stimulus once the economy gets back on its own 2 feet. Moving right along, let's step into summer, the late expansion. Now, the weather is blazing hot. The economy is absolutely booming, but there might be a storm brewing just over the horizon. The underlying characteristics are shifting. Remember that output gap? Yeah, it's completely closed now. The economy is basically running at max capacity. Unemployment is wonderfully low, but because the labor market is so tight, wages and consequently inflation start to accelerate. So that central bank hero from the spring, they're forced to play defense. Monetary policy shifts to being restrictive. They have to actively raise rates to force a soft landing, so the whole system doesn't just overheat and blow a gasket. Because of this, your trading strategy absolutely has to evolve. Sure, stock prices are often still grinding higher because corporate profits look great, but man, the ride gets incredibly bumpy. You've got to expect high market volatility here. You need to watch those rising short-term and government bond yields like a hawk. This is exactly when you want to start playing a little defense. Maybe trim back your exposure to those cyclical assets you loaded up on in the spring. The punch bowl is literally being packed up and taken away. And inevitably, that brings us to fall and winter, the slowdown and contraction. The economy has peaked, the leaves are falling, and we are entering the harsh, cold reality of a recession. It's not pretty, but it is predictable. Business profits and factory production start to slump. Corporate leverage, the amount of debt companies are carrying, is usually sitting at an all-time peak right now, leaving them extremely vulnerable. As companies lay people off and unemployment rises, that output gap swings back to being large and negative again. But there is a silver lining. To save the freezing economy from totally collapsing, the central bank finally reverses course. They step back in, start easing monetary policy, and drop rates to thaw things out again.
So how on earth do you survive this economic winter? Well, you have to shift your focus entirely. Move into interest-sensitive stocks that can hold their ground or even catch a tailwind as the central bank drops rates. You absolutely positively must avoid lower-grade credit and high-yield bonds. Default risks are surging right now, and credit spreads will widen drastically. Honestly, your main job in winter is just to protect your capital. Stay safe and wait for stock prices to finally bottom out so you're ready when the cycle resets into a brand new spring.
Let's move on to something really crucial. The trader's compass, reading the yield curve. Right about now, you might be thinking, okay, this is great, but how do I actually know when these seasons are shifting? Your absolute best tool for this is the yield curve. It is literally the trader's compass. An inverted yield curve happens when long-term bond yields actually dip lower than short-term interest rates. Guys, this is a massive flashing red siren. It is a prime indicator of impending economic gloom, mainly because it tells us the bond market is already baking in low future inflation, a pretty terrible long-term growth outlook, and inevitable central bank panic. And what's wild is how the shape of the yield curve shifts in perfect lockstep with our economic seasons. During the spring's initial recovery, the curve is really steep. By early expansion, it normalizes to a standard upward slope. As things heat up in summer's late expansion, it starts flattening out. When we hit the fall slowdown, it goes completely flat, or even inverts. And finally, during the winter contraction, as the central bank frantically slashes short-term rates to save us, it begins steepening rapidly all over again.
Okay, let's pull all of this together into your ultimate trading cheat sheet, mapping assets to the cycle.
This is the payoff. We are pulling all that macroeconomic theory directly into a practical business cycle trading cheat sheet. Look at how this flows. In the initial recovery, equities are riding high and rates are low. That's your time to be greedy. By late expansion, equities are still high, but they're getting super volatile as rates actively rise. When the slowdown hits, equities start falling, rates are peaking, and credit spreads are widening out. This is precisely when you need to be fearful and play defense. Finally, in contraction, equities are bottoming, rates are falling, and credit spreads are at their absolute widest. Keeping this matrix in your head is just a brilliant way to time your broader asset allocation.
But before you go and completely overhaul your entire portfolio this afternoon, I do have to issue a really important disclaimer. You have to beware the noise. Business cycles are not perfectly timed Swiss-made watches, right? The phases vary in length, and completely random external shocks, sudden policy changes, giant geopolitical events, natural disasters, they can completely scramble the cycle. So maintaining your flexibility and continuously monitoring the data is absolutely critical.
So I'm going to leave you with a bit of a challenge. Take everything we just went over in this explainer. Go pull up the financial news, look at today's yield curve, and ask yourself, based on the actual data staring back at you today, what economic season are we in right now? And more importantly, is your portfolio dressed for the right weather? Thanks so much for joining me today, and happy navigating.